Hi, my name is Pat O'Connor, and this is video number 16 in my National Mortgage Exam tutorial series. The information for this video comes from the study guide that I have published on Amazon. It's available in both Kindle and paperback format. And the second thing that you need to know is that quizzes are available for subscribers. Please make your subscriptions visible. You can do that by going to YouTube settings, privacy, and make the subscriptions visible there. The full instructions on how to request the download link will be above my head at the end of the video. All right, let's get started. We're going to be talking about loan products. And the most common loan product is a fixed rate mortgage. This is where the interest rate does not change throughout the life of the loan. Loans are usually 15 or 20 or 30 years for the fixed rate. The fully amortized, so that the entire loan is paid off bit by bit every month. There's no lump sum payment due. There is principal and interest each month. The last few years of the principal and interest is where you are really building up equity. That's when the interest has been paid down to the point where you're now paying more of the loan balance down. 15-year fixed rate mortgages may have a lower interest rate than the 30-year, but the monthly payments are going to be bigger because they're not spread out over 30 years. So if you're working with your clients, make sure that they understand, the difference. They'll pay less lifetime interest, but their monthly payment will be higher with a 15-year. Adjustable rate mortgages, they're also called ARMs, A-R-M-S, adjustable rate mortgages. These consist of two parts. You have a fluctuating index and then a fixed margin. The index is based on a published index like U.S. Treasury, Securities, or the London interbank overnight rate called LIBOR. It allows the consumer to see what the daily rate is, if they log into a financial site that publishes this information. So the index can change, it can fluctuate. The margin is the lender's profit and overhead, and that will not change. That is the bare minimum that they will make. And so that's usually 2 to 3%. So it doesn't matter what the index does, they're going to make at least 2 to 3% on the loan. So index plus margin equals the fully indexed rate. The interest rate can go up and down depending on where it is at the time the adjustment is due. Margins are expressed as basis points, where 100 points equals 1%. So I said a couple of minutes ago, margins are usually like 2 to 3%. So that would be 200 to 300 basis points. You need to know that for an exam. Margins are also called the spread. Adjustment. The adjustment period, it specifies the initial time when the first adjustment occurs and then the subsequent. So a 5-year ARM will have the interest rate constant for 5 years and then adjust most likely every year after that for the 20 or 30 years, whatever the actual long term is of the mortgage. So common terms are 1, 3, 5, and 10 years. You may also see a 7-year ARM, but those are the most common. Again, that will be the fixed period. Okay. A 5-1 ARM, 5/1, means that the first adjustment comes after 5 years and then it will renew every year after that. So that it doesn't go sky high, there are caps on how high this adjustment can go each adjustment period and then the lifetime of the loan. Again, the index can go up and down, so sometimes it may decrease, but never below the margin. So rate caps are typically 1 to 3% per adjustment period. Again, depends on the index, and 5 to 6% lifetime. So if you have a cap that's expressed as 2-3-6, you have a maximum of 2% adjustment the first year, 3% for subsequent periods, and 6% max lifetime. Again, that would be a 2 initial adjustment, 3 subsequent adjustments, 6 lifetime. Okay, the borrowers have to be notified of a rate change 6 months before the initial reset. Because it may be a sticker shock, right? They've been paying, maybe it's a 5-year ARM, they've been paying the same for 5 years. And now all of a sudden, it may jump. And it may jump a bit, if you have where it could jump 2%, could be the indexes are higher and it could be a 2% jump. It's also a heads up to people if they want to refinance out of an ARM and into a fixed rate mortgage. If it keeps going up, that might be a nice time to market to your customers who have these adjustable rate mortgages when they would be better off refinancing into a fixed rate. So watch it and track your customers, and good marketing tip. Okay, purchase money second mortgages. These are done so that the borrower can avoid paying the private mortgage insurance, PMI, without really putting 20% down. So these would be piggyback loans. So the first loan, they would put down 20%, so that if you have 80% loan to value, you don't have to pay private mortgage insurance. All right? So you put down 20%, and that's an 80% loan to value. Now they can get a second purchase mortgage loan on top of that to piggyback it. And that could be 10%. So now they're not paying any PMI because their first senior loan is for 80% down. So no PMI requirement. And now they're going to top one on top of that, pick one and put it on top of that. And this can be either seller financing or through the same or maybe a different lender. They'll simultaneously close. You're going to they will sign all the paperwork at the closing table. The 80% loan will be the bigger loan. and it's going to have the first lien position. So if there is a foreclosure, it will get paid off first, and then the additional mortgage liens after that, if there's any money left. So the 80% will get paid off first, and then the second mortgage loan might be at 10%. So now they had total 90% LTV. They had the 80, plus they have the 10, and they only have to put a 10% down payment now. And they're not paying any PMI. You can also perhaps get an 80-20, which would be 100% financing. So 80% for the first one, no PMI, then a 20% down on top of that. So you have no additional down payment. Everything is financed. Now, this is only going to make sense if after you go through all of this, your monthly payments are lower. The principal and interest part of your payments are lower with this piggyback loan than they would be without it. Otherwise, it makes no sense. Except you have more of your money to spend. So I guess it does free up your spending money, because now if you do an 80-20, you're not out of pocket anything except the closing costs. So keep it in mind, if somebody comes to you and says that, they don't want to pay PMI, but they also don't want to spend much money for closing, this may be a viable option for them. Balloon mortgages is the last thing we're going to cover. These usually are not qualified mortgages. So interest rate of these may be higher because Fannie Mae may not purchase them in the secondary mortgage market. Okay. There are a couple of exceptions to this, but for the most part, they're not qualified mortgages because you're going to have a fixed payment for a certain amount of time. 5 years, 7 years, 10 years are common fixed payments. And then you're going to have the balloon payment. So these tend to be 30-year terms, 360-month loans. Interest rate may be fixed for 5 years, and then the lump sum comes due. So this may be something if you have short-term projects and you want a fixed rate for a certain amount of time, and then, whatever you're doing, you may be okay to pay it off at the end of that period. But so the payments will be spread out as if it were a 30-year loan, but they will come due. So maybe you're doing like a long-term flip and you want lower monthly payments, and then you figure the resale value of this, 5 years, you have plenty of time to fix it up and resell the property and, flip it and get the tax-free money if it's your primary residence. So it may make sense for some of your customers that come in. And interest rates are typically lower than on a fixed rate mortgage because it's going to be paid off in a lump sum. If you see something that says 360/180, it means it's 30-year loan. That's a 360 months with a lump sum payment due after 15 years. That would be the 180. All right. So that is it for today. The instructions on how to download the quiz are up there. There's a couple of links following that to other mortgage videos in the series. And that's about it. I will see you next Wednesday. Thank you. Bye.